On selling your home and have a lot of equity tied up and you're worried about capital gains tax, in this video, we're going to go over exactly how you should think through the various levels of equity gain so that you avoid paying taxes on the sale of your home. Hi, my name is Zachary Jensen. I'm the managing partner here at TaxWise. And in today's video, we're going to go over exactly how you can avoid paying a ton of money in taxes when you sell your lifelong home. So, if you owned a home for several years, you may be sitting on a significant amount of equity, particularly those folks that bought things around the 2010 to 2015 vintage. As you know, real estate's appreciated quite a bit since then. And some folks have hundreds of thousands or even close to $1 million or more in equity, which is great news for their net worth. But when it comes time to sell, taxes can take a big bite out of your gains. Many homeowners assume that once they've sold, they simply have to pay the capital gains tax bill and move on. But in reality, for a lot of folks, this is some of the biggest money gain of their life. And they really need to spend some time, talk with a tax professional, and think it through because there are powerful strategies that allow you to legalize and legally at least minimize those taxes, reposition your equity, and even build some additional income streams through real estate investing that allow you to shield taxes. So in today's video, we're going to understand exactly how the IRS views gains on primary residence, how you can leverage things like Section 121 and cost segregation to make the difference between paying a six-figure tax bill and a $0 tax bill. So let's just say we are homeowners and we have a significant six-figure gain of, let's say, 500,000 or less. The Section 121 exclusion will take good care of us. So this is the first line of defense against capital gains on tax against your home. This rule shows that single filers can exclude up to $250,000 of gain, and married couples filing jointly can exclude up to $500,000 of gain as long as you've lived in the home for 2 of the last 5 years before the sale. So let's say you buy your home for $400,000. Now you sell it for $1.4 million. That's a $1 million gain. And if you're married filing jointly, $500,000 of that gain is completely tax-free under Section 121. This leaves a $500,000 taxable gain. And without planning, this $500,000 would typically be taxed at a long-term gain, likely around 50 to 20%, plus more if you live in states like New York or California, which could mean a massive six-figure bill. But the Section 121 exclusion easily gets rid of half of that for us, and it doesn't eliminate our problem, but that's our first line of defense. So let's move on to the next thing we can do. After we have the 121 exclusion and we've got this remaining $500,000 in our example, many sellers are simply tempted to pour it all into cash or into their next primary residence. And while this is an option, it's not the most tax efficient move. Instead, consider this. Let's say you're going to buy your next home and you're expecting to do it in cash because you're older, you're looking to retire, you don't like the idea of no mortgage. Okay, fine. But let's say rather than doing 100% cash, let's say you do 50% cash and 50% mortgage. So it's still conservative and you're only using part of your equity. Let's say $500,000 goes towards this down payment. That leaves another $500,000 free to invest. This money can be actually used to acquire a rental property, which not only generates income in the future, but also comes with valuable depreciation deductions. This is where smart structuring can turn into what would have been a big six-figure gain in a tax bill into a loss in a tax shield. Enter the cost segregation. So this is a strategy where you hire a specialist to break down a rental property's components like appliance, flooring, fixtures into shorter depreciation schedules. Just for a few $1,000s you can do this. And this allows you to take a much larger depreciation deduction in the early years of ownership. And here's where it gets interesting. Depreciation deductions from rental properties can actually offset your taxable gains, including capital gains from the sale of your primary residence. So in this example, let's say you bought a $500,000 rental and did a cost segregation that accelerated $150,000 in depreciation. That $150,000 could offset part of your $500,000 taxable gain from the sale of your home, and you could scale that up. Let's say you do $1 million rental and you put 30% down or whatever it is, you can, or $2 million, you put 25% down with your full 500K, you can generate a ton of depreciation and you can do the math on exactly how much you need to offset. And while depreciation is generally considered passive, it can be used to offset capital gains. So you don't need to worry about qualifying for things like real estate professional or anything else because it's already passive by definition. So depreciation reduces taxable income on rentals as well in the future, freeing up other deductions to apply against future gains. And another overlook point, you can provide, or rather perform, this cost segregation not just on your new rentals, but also rentals you've owned for years. So usually people in this situation have a rental or two, and they can use the 3115 form change in accounting to catch up the depreciation and won't be as potent as when they first bought it, but it still could do significant damage to their tax bill. So to sum it all up, homeowners with large equity stakes should really consider before automatically selling, paying the big tax bill, and then immediately going and buying their next home. First, they need to maximize that Section 121 exclusion. Then, instead of plowing all the cash into the next home, they need to consider splitting it up, some towards a new residence, some towards a new rental, or doing cost segregation on old rentals and timing it so you can generate depreciation deductions that can soften or even eliminate taxable gains. This is super, super powerful stuff. It can eliminate 6 figures of taxes or more potentially. The pros of this approach are clear, right? You pay lower taxes today, you get either a new asset or are able to do a depreciation on your old assets, and you get to take more money home. The con is that cost segregation requires some fees up front, and the deductions may be limited if you go to sell too early because of depreciation recapture. But in the end, for most homeowners with large equity, combining Section 121 with rental investment and cost segregation is one of the most powerful ways to take what would have been a very large tax bill and reduce it to nothing. So if this is a strategy that you're interested in employing for yourself, please reach out. My contact information is in the description below this video. Thanks so much for watching and have a great day.